we'll move into it. So today, the agenda is pretty much about the big issues that we're actually seeing right now. And we want to be able to provide you with some options for current cash flow difficulties and some survival techniques. So Steve will share with you some formal approaches as well as some informal. And then I will talk to you a little bit about Safe Harbour and how that might work well for you and your clients or the business that you're working with in terms of business recovery. And Stephen will then bring back the issues around personal bankruptcy and individuals who are suffering from some personal distress. Now, through this, if you want to send us questions, send them through, and we're seeing those. We've already got some from you already. And in between each of those sort of broad brush headings, we will stop and cover some of your questions if we've got them. So feel free to keep on pushing in through those questions to us. So Stephen, I might throw
30, isn't it? Yeah.
A little bit of feedback there. Might throw over to you, Steve, about the biggest issues that you are now seeing.
Sure, thanks, Alex. So obviously, probably the number one issue with any advice we're providing at the moment is how that impacts JobKeeper. So any solution we look at the moment is to ensure that JobKeeper is maintained and we meet the requirements of that particular process. The other issue at the moment is obviously dealing with historical ATO debt. The ATO has become a lot more receptive in relation to dealing with ATO debt compared to, say, 3 months ago, because obviously the government philosophy has changed completely. The government obviously is in survival mode, so to speak. They want businesses to maintain employment. So currently there's a lot more flexibility in dealing with the ATO, as I'll illustrate in a couple of minutes' time. The other underlying issue that we're finding is one of current financing, the availability of credit. As you can imagine, the credit criteria now being provided by banks, second-tier financial institutions has changed remarkably.
Yeah, I know. I'm trying to work out how to get around it.
That's also creating other issues, particularly if we need to restructure a business, or even when business come out of hibernation mode, how they're actually going to have the working capital to continue. There has been a complete change in credit policy, and that's obviously in part because of the impairments that you've probably seen. Impairment of loans by the Big Four in particular have skyrocketed, for want of a better word. So these are the issues that you'll see taking place and have to be dealt with over the next particularly 3 to 5 months. And obviously one of the uncertainties further is how much longer JobKeeper will continue for. So that gives you a background of, from my perspective, what I'm seeing with quite a diverse client base. And I receive referrals from an array of accountants and lawyers, and that just gives you a feel for what I'm seeing right now. What I might do now is turn to the formal insolvency side of things. So the first and probably most common one you'll hear everyone talking about at the moment is voluntary administrations. It's a very flexible process. It's a process that generally lasts for 25 business days. It's a process that obviously is currently being undertaken by Virgin. So it gives you a real life example of exactly how that process can be used to save companies. It's a process that basically puts your creditors into a moratorium for that period of time. It allows the independent party to look at the financial position of the company, look at also its processes, and basically allows it to be restructured and brought out the other side. And how it's brought out the other side is through what's called a deeded company arrangement, which is a compromise of creditors' claims. Now, there's been a lot of talk at the moment in relation to what is called a holding deed. A holding deed is a concept that's been around since VA, since 1993, hardly ever used, because a holding deed is basically putting the creditors into a holding pattern until you can determine exactly what proposal you can put to them. And I've got a live example where I've used a holding deed in the last 3 months with a company based out of Perth, because it owns a property. Because of what's happened with COVID, the property price has obviously diminished significantly. Rather than putting it immediately on the market, what we've done, we've engaged an agent to help us lease the property out or sublease part of the property out. That will underpin the property's value because we'll get obviously a rental return, and that will then provide a yield to underpin the value. Now, rather than putting that straight on the market and saying to creditors, this is what you're likely to receive, we need to go through that process first, realise other surplus assets, and then we've said to creditors, we'll go back to you in 3 months' time with an overall plan. So there is an example of a holding deed, which again, in my view, creditors would not have accepted 3 to 6 months ago. Now they're readily happy to accept that sort of arrangement because they see an end game, but they also see that there's a strategy that we're endeavouring to implement to effectively provide value back to this entity. So we can actually shrink the entity, keep a core number of employees, utilise only part of the factory, sublet part out, and as part of an overall strategy that we were able to effectively determine, and now we're in the implementation stage as part of this holding deed. Now, as part of the holding deed, the company actually returns to the control of the directors, so they continue to trade that business while we implement the other action items, effectively, want a better word, in the background. If a deed is not possible, the company can end up in liquidation on that 25th business day. The problem with when a company ends up in liquidation, JobKeeper actually ceases at that point in time. So there is an added incentive to put a company through a deed of company arrangement, if that's at all possible. That is purely, it allows us to maintain JobKeeper and obviously, therefore, hopefully, assist us keeping a number of employees in place rather than actually looking at immediate redundancies. Now, as part of that, we still can make, unfortunately, employees redundant, but generally at the moment, that's obviously not our preferred option. Our preferred option is to find a way to save that business, and that's generally what we're doing. We're currently appointed to 3 other companies where we're going through voluntary administrations. At least 2 of those, if not all 3, will end up in deeds because we believe we've got a core business that we are able to maintain through that process. You can also adjourn that meeting, or you can go to the court and extend the convening period if you need an additional period of time. So if that 25 business days is too short, we can actually extend that period of time. So there's a lot of flexibility in that. The other issues we'll also touch on today will be the informal or safe harbour, which is something that you'll see a lot about in the media at the moment. People have spoken about. It's a piece of legislation been around for quite a while, and we'll also look at the liquidation process. Just to recap on voluntary administrations and the advantage of it, it really provides that moratorium period. It also allows us to look at renegotiating leases, other contractual arrangements. So it can't be understated the flexibility this process holds. It's a very important process. For my practice, we probably spend 50% of our time going through the voluntary administration process. It's really an option that we really try and drive home, where we believe we do have, and this is very important, we do have a core business that we can deal with and restructure in some shape or form. The other options that creditors have, or that directors have available to them, is that they can place a company directly into liquidation. Unfortunately, that's more of a terminal type arrangement. Effectively, you manage the wind down of the business. You might go and collect the debtors, sell off the stock, sell off the plant and equipment. Now, that doesn't have to be done through an auction process. It can be done through advertising the business for sale, or approaching competitors, or even suppliers. So it's just a case of thinking outside the box, how you can maximise the return to the creditors and hopefully sometimes shareholders. In relation to a liquidation process, it allows you then to engage with the government FEG scheme, which is the scheme that pays any outstanding employee entitlements. So if the company does not have sufficient assets to meet those obligations by going into liquidation, the FEG scheme will pick up any outstanding wages, annual leave, long service leave, redundancy, and notice period. What it doesn't do though, it doesn't pick up outstanding superannuation, and there's obviously a personal liability there for the director or directors. So it's as advisors, we need to be cognizant of the fact that that liability will need to be dealt with in some shape or form. So in organising or in being involved in that process, that planning process, we need to be alert to the fact that there will be a personal liability issue in relation to outstanding superannuation if a company goes into liquidation. But again, as part of that process, it's about managing the process, it's about managing the realisation of the assets, ensuring there is a maximisation of that process, and therefore trying to minimise the loss to the creditors at the end of the day. One of the questions that we get asked all the time is that how do we get paid? We get paid out of the assets. It has to be approved by creditors. We generally agree to a fixed fee, so therefore there's some surety for the creditors and also the director and shareholders that they understand what the likely return will then be back to the creditors or the other stakeholders. So we try and then just again provide those couple of other options that may not be otherwise available. So that gives you a position as an alternative to obviously the voluntary administration process. As I stated earlier, with the VA process, it gives us the ability to renegotiate leases, work with the banks, suppliers, and then really restructure the business. One of the other things I have been involved with recently was a franchising business. We were actually able to deal with the franchisor and renegotiate that particular franchise agreement, and therefore, again, restructure the business to allow it to come out the other side. So what you're finding at the moment, or this is what I'm finding, you're finding a lot more flexibility from all the parties involved. One other piece of legislation you should be alert to, it's been around for about 2 years now, is the ipso facto legislation. If you've entered any supply or your clients have entered any supply agreements post 1 July 2018, if they end up in voluntary administration, those supply agreements cannot be cancelled because of the insolvency event. So no longer can a company effectively be held to ransom because it's become insolvent. If there are other breaches of the contract or the contractual relationship, that's different. But if the breach is due to the insolvency event, no longer can that be relied upon to cancel that contract. That is an extremely powerful tool for any contracts entered into, particularly after 1 July 2018. And I'll give you a prime example of that. You may have a supply contract for raw materials, or you may have an electrical contract where you're receiving supply at a discounted rate. No longer can they change the price because of the insolvency event. Therefore, it underpins the expenses, or it underpins, you know, what you're up for material cost when you're obviously preparing budgets or looking at forecasts as the business moves forward. So it's a piece of legislation not a lot of people are aware of. Again, we utilise that piece of legislation just to ensure that we, once we resurrect the company or we put it through a deed, that we understand what the input costs are going to be as we move forward. So again, it's understanding the legislation, what you have available to you to when you're trying to review the company's position and then work out how you're going to then restructure things and move forward with the company. So that hopefully gives you a summary of the voluntary administration process. Ultimately, it's a case of the creditors have the say at the second meeting. They determine the future of the company. So it requires a resolution of majority number and amount to approve either a deed, or alternatively the company can end up in liquidation. So at the end of the day, the report we produce provides a recommendation, but ultimately it is up to the creditors to determine what they want to do with the company, if they want to see it continue, or they can then place in liquidation, and then it's a slightly different scenario. The other thing you should be alert of also when a company goes through voluntary administration, directors or guarantors cannot be pursued for any debts during that period of time. So not only does it put a moratorium in place for creditors of the company, but it puts a moratorium in place so the director or anyone on the side of personal guarantee cannot be pursued during that period of time. So again, it takes a bit of pressure off the director or the other stakeholders while we try and deal with the restructure process rather than them being attacked on a personal side as well. It's also they can take a little bit of comfort for a period of time that we can just deal with the company's issues solely, and then obviously we can look at their personal positions post the outcome of the company. So I hope that provides a reasonable summary of both processes.
That's excellent, Stephen. I think that gives people a good background and an insight into some of the practical things that are actually happening out there. And like a lot of things that we read in the media, not everything is absolutely accurate. So
Correct.
if in doubt, just reach out to us. We've had some questions come through already, and just to remind you that we will be sending out slides, a copy of each of this to those of you who would like it. So just drop us an email and we'll provide those details to you. And the slides will give you something further to that which I and Stephen have shared with you today. So at this stage, we were going to break for a quick Q&A, but we might, unless you've got some questions that you see right in front of you, Steve, that have come through.
So if there's...
I've dealt with the ones that have been coming through here, but I know there was a couple sent to us a bit earlier. Do you want to deal with those towards the end, Steve?
Yeah, we might. I can't, to be honest, I can't quite see them, Alex, so we might deal with them towards the end. So,
right. And Andrew might be kind enough just to
exactly right,
through to us, and we'll deal with them. So we'll keep going on. So thank you for the little bits of feedback we've been getting along the way. It's interesting running this, and it's quite interactive. So we're getting some good feedback from you. So I mentioned at the top that my passion is really around helping businesses create a business that's really profitable, valuable, and enjoyable. And if nothing else, this whole period through COVID-19 has really disrupted the plans that many of us had in place, regardless of whether you're in practice or whether you're in industry or commerce or banking, retail, wholesale, distribution, manufacturing. Whatever plans you had in place were literally ripped out with very little notice. So it's been a classic case, and we've all heard about the stories of disruption. This was a disruption that occurred without very much notice. Like all things, as an optimist, I see there's some good news. There's still very many that are struggling to survive at the moment, and our heart goes out to each of them. And for some of them, the subsidies won't be enough. For other businesses, they're now seeing a little bit of sunshine, and we can assist in a number of ways there. So at the core of the way that we like to operate is to provide people with options. And our experience is that people tend to have very many more options than they think. So like a lot of things, reach out and let's help you explore those. So I want to talk a little bit about Safe Harbour. And again, we've got a wide variety of people on the call today. And I'll talk a little bit about it being an exception to the rule, because directors really got to be careful about trading when they're not solvent. But this really provides an additional defence to a claim by any liquidator or creditor against the director personally for any debts that are incurred by the company while it's solvent. And that's pretty important in the current environment to be able to understand that and perhaps take advantage of that situation. In addition to that, there's a great chance for directors to be really quite proactive, as I've said, because many people are still in reaction mode. But I can tell you that those in your industry or in similar or complementary industries are actually looking to see what they can do to deal with their current situation and do something proactively and positively about it. So the benefits of Safe Harbour really are about protection for the director, but the directors really have to follow certain actions. And ultimately, what we really want to have happen here is a restructuring plan that we put into place through this Safe Harbour process, which I'll take you through some detail in, whilst to avoid that, to keep solvent and help us deal with the creditor claims. That's really what we want to be able to do. We want to be able to return the company, at least part of it, to a good operating state with better practices and things that perhaps are a bit more effective. So there are 5 key things that you really need to be thinking about in terms of the Safe Harbour provisions if you really want to be able to continue trading, if you feel like you're on that brink of insolvency. One is that we really need a plan. There needs to be a restructure plan that shows that the parties will receive better outcomes than if they went straight to liquidation or to administration. So there needs to be that plan in place. In addition, with the goals, like all things, we need to be satisfied that there are specific and documented goals with clear timeframes that will impact and affect all of the parties to the situation. What's really key, though, is that you're compliant with the ATO in terms of your reporting. We need to be able to continue to pay employee entitlements and deal with the superannuation. For it to work effectively and to meet the regulations and legal provisions, it needs to really be done and overseen by a qualified person. So an insolvency specialist, somebody who is independent, who is skilled, who's experienced, and who's not blinded or conflicted by the situation. And like all things, the last point that's key to Safe Harbour is about the review process. There needs to be consistent review monthly with the board and all the parties, updating exactly where it is that we're up to. So again, we'll send these slides through to you. What's really important, we find, in dealing with businesses as they're going through this recovery is their ability to ask really good questions of themselves, of their business, of their clients, and what value that people are actually getting. How can they become more effective? So we encourage everybody to really understand what are our key objectives here. Now, I'm talking about right here, right now, in this situation of varying levels of distress. So what are the key objectives? What are the must-haves that we really want to achieve? And to the extent that we want to have successful outcomes, or I said before, better outcomes than you would have had if you'd gone to liquidation or administration previously, then what would be an indicator of good success? And it's helpful to get that documented so that we're all clear about our expectations and the timing of that. And then we could keep our focus on making sure that we stay on track. And the last one is really understanding the value that's provided to all the stakeholders. So in terms of business recovery, we titled this a Survive and Thrive Action Plan. And the key word really is around action, because quite honestly, at the moment, it's the businesses that are taking action, that are seeking out advice, that are having something that they can measure and manage, that are really have the greatest opportunity of coming through this entire process. So some of the things that we're seeing right now is businesses are really asking of themselves, it's been forced on them. Cash flow is really being difficult. Revenue is being crunched. Lots of challenges around resourcing, around key target markets, supply, all sorts of things. So some of the things we're seeing is that people are getting a great opportunity to think about what's my return on investment on every bit of expenditure that I make. Do I really need to be doing that? And I must maintain relationships with my suppliers, with the ATO. We're seeing some brilliant situations occur there that are unprecedented, and Stephen will touch on those perhaps a little bit later. We're also seeing people looking at the opportunity of converting to debt, some of it to debt with the bank on better arrangements, while we're getting some empathy from everybody. The main thing though, as in always, is that cash flow really is king. We've really got to make sure that we've got a strong handle on our cash flow. And lots of people are looking at that more closely than they ever have before, and looking at how they can free up particular assets, turn them into cash. In other words, they're being quite proactive with the assets that they actually have, more so than they ever did. So it's like a lot of things. There's a whole set of what we would call new normals that we are seeing come out of this. And like anything that's new, it's sometimes a little confronting, it's sometimes a little bit challenging, but through this process, and you probably would have noticed that both personally and professionally, there'll be a lot of new habits that you have been almost forced to adopt, not just working from home and distancing, and the way that you communicate, the way that for many of you, the better prepared businesses were well and truly in the cloud. They had risk mitigation and contingency plans in place, but many have learned to adapt and innovate just to stay alive. So that's been really important. A lot of businesses, depending on the level and their size, have got a little bit complacent and haven't always looked at their cash position and the forecast, the impact on the balance sheet. We're seeing many people now look at really some key strategies around where they really make their money, and their margins, their product mix, they're thinking about, they're questioning why is it we're doing what we're doing in terms of the services that we deliver. Which ones are more profitable? Which ones are where we can, not only if they're profitable, but which will produce good cash flow for us. So it's this balancing act of profitability, cash flow, and then also making sure that we are being effective with our systems and our processes and our throughput so that we can deliver the value that people are seeking. Because right now, people are looking around, they're questioning the value they get from a whole range of their suppliers. They've been let down on occasion, not deliberately, but in many cases, resources have not been able to be to supply the stock that's normally required. So at the moment, they're finding out, who can I trust? Who do I believe in? Who has supported me? And probably more than ever is how people have made them feel, how they've been cared for, and the experience in being a customer of your business. So there are a lot of things that you can do. And again, talking about new normals, you know, we've all seen the change, again, enforced upon us in terms of working from home. So what does that mean for commercial and office space? What does that mean for the size of warehousing? We've seen that very many distribution companies come on board with logistics, and people are changing the habits they once had. Given that we've not had domestic travel, there's been a whole range of ways that people have stayed in contact, and we have developed, as I said, some new habits. So it'll be very interesting to see what the new normals might be. My big question I ask of you, to ask of your business, is to think about, what is it we do that differentiates us, and that our client base, our customers, and new potential customers would value, and how can we deliver that value to them in a way that we've reduced the friction, we've made the experience good for them, and that they believe that the product or service will do exactly what it says it will do. So wrapping that all together with a whole range of business recovery, reconstruction and safe harbour, there are lots of opportunities for business to think about how they will do business as the restrictions are gently and progressively eased. So that's what I have to say on that part. Do we have any questions at this moment? I'm seeing there's one or two there. Let's have a look. Somebody else asking for the slides, absolutely. Stephen, we're running pretty well in terms of time, whether you want to deal with any questions or whether you want to move on to the issues around the personal situation in terms of those suffering financial distress.
I would probably move on. Just a couple of comments in relation to Safe Harbour. In relation to, as Alex said, a couple of things. In relation to the plan, it's got to be for a defined period. So the Act requires that it doesn't go for an undefined period of time. Second thing is, in my experience and Alex's experience, it's really designed for more larger family-owned companies or small public companies because of the process, what's required. As part of that, obviously, as advisors, we need to make sure that we work with you to make sure the financial accounts are up to date. So we have not only the financial information, but the operational information we need to implement that Safe Harbour plan. And I think you'll see a lot more Safe Harbour type arrangements, particularly after JobKeeper finishes. But it provides a further option rather than going down the formal insolvency route. But the problem is, if there's an ATO debt, unfortunately, you don't qualify for Safe Harbour. And that, to me, could be a fault in the legislation, so to speak, because a lot of people have arrangements with the ATO, but purely by having an ATO debt, you don't qualify. But that's probably more of a political comment than anything else. But that's one, unfortunately, where one of the criteria to meet Safe Harbour. But yeah, it's one area that Alex certainly has been working on.
Now, just to extend that a little further, Steve. So, how do you see businesses making that decision about whether I enter into a Safe Harbour situation or whether I don't? What do you think some of the considerations they would be thinking about, or what might be the first step for them in, for example, reaching out to someone for some advice on that?
I think it's actually a very good question. What I'll be doing is, initially, I think I would look to see if there is an option for Safe Harbour rather than the formal insolvency route. And that will obviously depend on the core cash flow, how we think, and then make sure there's free cash flow so we can pay the ATO debt, meet employer entitlements, and also see where what products or product lines you can maintain to go forward to underpin that cash flow. So as a first option, you'd obviously look at that. The only issue is though with Safe Harbour, as I said, it will depend very much so on the size of the business because of the costs associated with it. Because you've got to have regular meetings, you've got to have a structure in place to meet that potential cost. So even though voluntary administration people shy away from it, I think to a degree it can be undertaken quicker, where Safe Harbour can take longer. But Safe Harbour, to me, is really more set up for larger family companies or smaller publics.
Okay, then that gives some good context, Steve. Is it in terms of that sort of size of company and the cost? It's not as expensive as it used to be, though, is it?
No, correct. It's certainly something that I think once you've got a template for how you can do that, like we've got some template reports and templating financials, that sort of thing, I think you can actually implement it. You're right, it is a lot cheaper than when the legislation first started, because it was, I suppose, a situation where we all trialled it and worked trial and error and see what worked. But it's a case where, again, the responsible plan, we've got a templated plan, which then we can just sit down and then tailor for the individual business.
Okay, very good. Well,
Now,
back
do
to
you
you,
want to look
Steve.
at the personal insolvency side? So very briefly, a lot of inquiries we're getting at the moment is in relation to people's personal position, unfortunately. Effectively, there's really two types of personal insolvencies. One is where people can enter like a Part 10 arrangement, which is effectively like a deed of company arrangement for the individual. People see that as an advantage over bankruptcy because they just don't like the word bankruptcy and they don't want to go bankrupt. So there's two immediate options. One other option you should be aware of as advisors is it's called a debt agreement. This was set up about 5 years ago now by the government purely to deal with people with credit card or small gambling debts. There is a threshold in relation to debt agreements. It's about $118,000 worth of debts. Unfortunately, you've got to also have minimal assets. But if for an individual that has credit card, personal loans, gambling debts, there is this debt agreements can be entered into by effectively employing what's called effectively a debt manager. It's not something we would do, but we would assist with. So you basically have a debt administrator that oversees that arrangement. They put that in writing to the individual's creditors, and then they would be seeking their approval through a resolution that's actually passed by the parties returning a piece of paper to that debt administrator. But it basically gives you an alternative to bankruptcy in a Part 10 for people with small debts. Historically, credit card companies through debt arrangements have looked for returns around 35 to 45 cents on the dollar. I would suggest in the current environment that's going to change. It obviously will come down, but again, that gives you effectively a benchmark for any clients that you're trying to help that has a level of debts. Now, when I say a benchmark of 35 to 45 cents on the dollar, that's over a period of time. Generally, I've seen debt agreements go from a period of anything from 2 to 4 years. That's again why, to a degree, I don't like them. But again, it is an option available. The second option is obviously if the individual believes that they're obviously insolvent, they can actually go bankrupt. Now that, I know it sounds bad, but there is an option for someone that does go bankrupt. So just to give you the context of it, bankruptcies generally go for 3 years. Obviously, they cannot keep or have an asset like a house, but however, in saying that, they're entitled to a car worth $8,000. They can earn about $82,000 gross before having to make a contribution to their estate, and that threshold goes up depending on how many dependents they have. If they do own a house, what we've done in the past is that we would sell that equity either to their spouse, because they'd be only entitled to a portion of that equity. So we find an arrangement or a way, if possible, for those parties to keep their house, because generally it's their principal place of residence. They may have children, so they want to keep the family in a stable environment. So there are options in relation to trying to maintain that house. Even excuse me, even though bankruptcies go for 3 years, there is something called a Section 73 composition. That is an arrangement with your creditors where you can put up a cents in the dollar deal. Again, that's generally 5 to 8 cents in the dollar, similar to a deed of company arrangement. If creditors accept that at the meeting, their person's bankruptcy is annulled and they get out of bankruptcy at that point in time when the meeting's held. So within that 3-year period, the advantage of a composition is that it actually comes off the bankruptcy comes off their credit history. They can actually tick the box that they've never been bankrupt when they apply for credit. The reason behind that is their bankruptcy has been annulled. So from a legal perspective, it actually never took place. So this Section 73 composition is an extremely powerful tool. We now probably do 1 to 2 of those a month with our clients because it gives them a fresh start. They can then become a director again. They can go and borrow money. They can go and acquire assets. So please don't think because you've got a client that, or a friend or relative, whatever it may be, needs to go bankrupt. There is an option. They can look at this composition arrangement. We generally enter that arrangement anytime after about 6 months after going bankrupt. Let the dust settle. We've done our investigations. Then they put their offer up to their creditors. So similar to a deed, what they generally offer their creditors is somewhere between 5 to 8 cents on the dollar. A Part 10 arrangement is still something that's used occasionally. The regulators don't really like Part 10s because effectively from a regulator viewpoint, they believe that the person is to a degree getting off the hook. So they're offering an arrangement to their creditors. The problem with a Part 10, it requires a resolution. If that resolution fails, they have then entered an act of bankruptcy and they will end up going bankrupt. The Part 10 is an expensive process. It will take you about $15,000 to $20,000 to take them through that process because of an extensive investigation of the individual's affairs. It culminates in a report to creditors that has to go out on the 25th business day, and the meeting of creditors is held on the 35th business day. So a Part 10 is a very intensive process. However, it allows the person to maintain being a director up to the point that arrangement is accepted. But when they go through the actual Part 10 arrangement and make their instalments or whatever they offer, they cannot be a director for that period of time. So they can maintain their directorship up to the point of the meeting of creditors. Post that, they effectively have to come off being a director for that period of time while they go through that Part 10 arrangement. It's not something we do a lot of, and the other reason behind that is because it sits on their credit history for up to 5 years. So unlike a bankruptcy where you can clean up their credit history, if you do a Part 10, it generally gets stuck on your credit history for 5 years. Any potential financier will see it, they will ask questions, and generally they will pay a higher interest rate because of that arrangement, or they could even be knocked back. So it's certainly something available, but it's just not something that we do a lot of for obvious reasons that I've just outlined. So again, there are options in relation to individuals that have debt issues they need to deal with because of guarantees or shortfalls on leases, whatever it may be. As I said, we're doing more and more bankruptcy or personal insolvency work right now. Again, a couple of options available to you that you can take to your clients. Again, we're happy to meet anytime, anywhere, no obligation basis to go through either their corporate options or their personal insolvency options. I think you're muted, Alec.
I'm fine now. Good, thank you. The dynamics of being on stage, even if it's
Correct.
Stephen, you outlined some really good points there and options for people at a personal level who are suffering from financial distress. And I guess we all know, if you've ever suffered from that at any point in your career or your life, not just now, is that we don't always make the best decisions, and we turn to others, and sometimes the others are well-meaning or well-intentioned, but they're not clearly expert in dealing independently and without emotion. And I know emotion's important because it's about you and your family, but in terms of dealing with the options that we see, we don't often see that that's happening as often as it could. And if we were to give you just one piece of advice, that reach out. At some stages, it's sometimes too late, and we'd rather you reached out earlier in the process to explore what your options might be. And even if you got some greater peace of mind by knowing that you'd have done everything you possibly could, the outcome might not be great. But the experience and the feedback that Stephen and I get is that, gosh, we wish we'd come in and seen you or somebody else like you a lot earlier. I guess you're seeing a bit of that as well, Stephen, even in the corporate space.
Oh, absolutely. The number of coffees I have or a number of meetings we have where there is no obligation, try and at least get the background, understand what the issues are, give people then time to, I suppose, go away, just comprehend it themselves, think about it, and then they come back. It's not uncommon to have 6-10 meetings just in relation to understand all the issues, because the more you talk and the more questions you ask, the more information you then can glean from that individual or about the company or the individual, and then you can actually then come up with that action plan. But the more information you get, the more accurate that information is, financial or otherwise, the better advice and better decisions everyone can make.
Okay. One of the questions that I've just got in from somebody is asking us how do we deal with people who've got their own accountant or their own referring party to us, or if they're a financial controller in their own commercial company. So the question was really coming from a professional point of view, those accountants in profession and those accountants or CFOs that are in commerce. They're just interested in how does the relationship tend to work?
Well, first of all, we would work with the advisor, as you and I know, Alec. So it's a case of we're reliant on the information. So if particularly we trade the business, we would actually engage with either the accountant or we'd maintain the financial controller in their current position. So therefore we can work through the process. We would then, once we've, say the company goes through a deed of company arrangement, we would return effectively the client back to that advisor. So being completely independent and a boutique firm, we have no allegiance to higher beings, or we don't have other divisions with business services or tax. So the aim is then to return and work with that advisor, the solicitor or the accountant, to return it back to that particular advisor, hopefully in better shape than we entered. So there's no conflict issues. It's not uncommon for us to engage that advisor to help us maintain the financial accounts, because it then also allows them to maintain the relationship during that period of time with the directors and other stakeholders. Again, if we had a financial controller, we would rely upon them, and we would just get them to report into us as well as into the directors. And again, we would maintain that position. And so it's very important that we work with all professional advisors that were there prior to our appointment, because they've got the relationships, they understand also the emotional connections and the other issues. That's the way we undertake the process.
Okay, I'm getting a few questions in now, so obviously there's some people interested in this part of it. We're talking mostly here to people who are CPAs or members of CPA Australia, but a couple of the questions are touching on some other things about how do we work with lawyers, and what is the relationship? What's the best and most effective way, so I'm not doubling up with cost or duplicity of telling you the story all over again. How do we tend to work with lawyers, and how do they fit into this piece and their importance, Stephen, over both at a corporate level and maybe at a personal level?
Sure. So again, if the company or directors have a relationship with a law firm, we would generally work with that law firm because they understand the contracts, again, the individual, whatever's involved. So we would work with them to look after the legal side for us. We do have a panel of lawyers that we work from within our practice. They range from smaller firms with, say, 2 or 3 partners up to medium-sized firms with, say, 20 partners. It just depends the size of the business, the complexity of the issues involved. If we need specialist advice, for example, at the moment I've got one involving patents, so I need a patent a lawyer. Now, again, that company has patent lawyers that we're working with, so we're working with those lawyers because they understand the background. It's a lot cheaper than if I bring a new firm in to try and get the background, understand the issues. So it's all fit for purpose. It's again, it's very important. Our business is all relationship driven. Therefore, we want to maintain those relationships. We want to work with those parties because they understand that, they understand the background, the history to it. And at the end of the day, they're in financial trouble for a reason. Therefore, if the cheaper we can make it, the better outcome we're going to end up for the ultimate stakeholders, being the creditors and the directors.
Okay. So when you think about the ways that we've been able to, over this last, let's call it 6, 8, 10 weeks, work with parties to negotiate, Steve, to the extent that you can share it, because some of it is private. But what's been your feedback or experience of working with the ATO and also with some commercial landlords? And the other question, I'll give you that one, and there's another question I've got that's just come in.
The first one, in relation to the ATO, we had a deed of company arrangement was proposed a couple of weeks ago. The ATO accepted 9 cents on the dollar, which was unheard of. I would have said 3 months ago, minimum they wanted 18, 20 cents on the dollar, compliance, everything lodged on time. So there's the compliance piece as well as the return to them. On this occasion, they accepted 9 cents on the dollar. That gives you a very fair indication of how government policy is now being relayed through to the ATO and how they want to maintain the employment of people. So this company was in administration, they put up a deed, it was accepted. In fact, the ATO actually voted for it. Generally, the ATO would abstain. In this case, they actually voted for it. So it shows you the shifting in philosophy from a government policy viewpoint to now what's being implemented by the ATO, which is great. It gives us that ability just to restructure things, but I suppose more surety that at least you can get a level of support from the ATO, which is really good. In relation to landlords, what we've been able to do on one other client recently, rather than going from a fixed rent, we've gone to a percentage of rent based on the industry benchmark, because we're able to sit down with the landlord and explain and they could see it in black and white, what's happened to this business. So what we've been able to do is effectively revert to a turnover-based rent for a period of time for the next 12 months. And then we said we'd come back in 12 months, look at where the business is at, look at where the industry's at, and therefore the landlord was receptive to that. So we've basically been able to underpin, once again, based on the turnover, the costs of the business based on industry benchmarks. So that's a complete change, moving back from fixed rents, where again, and in fact, the landlord was willing to provide a 3-month rent-free period, as well as converting to a percentage of turnover. Now, it requires honesty on both sides of the fence, because obviously the turnover information needs to be provided on a confidential basis. And the way we underpin that is we've got the accountant, so the external advisor who is employed, who's always been involved. They were going to report back to the landlord on a monthly basis. They would look at the financials, the management accounts, and then because they're a CPA, I think they're pretty sure they're a CPA, not a CA, they were then, because of their professionalism, we're going to provide that information to the landlord. Then the landlord took some comfort, because of their professional background, that the information they were going to be provided was correct, and therefore the rent was going to be based on a turnover based on industry benchmarking rather than a fixed amount. So it just gave, again, the business the ability to effectively control its cost base moving forward for the next 12 months.
Okay, thank you. We've got 2 questions and we've got about 6 minutes to go, so we're running pretty well on time. One of the other questions I've got in from somebody is, what do you see as the best way to realise assets in a business that is in some financial distress, and what assets are included?
Well, again, it depends. That's obviously a very broad question. At the moment, I would be reluctant to take assets to, for example, plant and equipment to the auction market, because that market to a degree has been decimated. It really is, if you want my honest opinion right now, what I would be doing is either effectively slowly realising those assets over a period of time. So you don't want to put a large number of assets on the market at once. You really want to either do it yourself through there's advertising means. For example, I've had 4 or 5 vans on a job where we actually put them on car sales. We got a lot better outcome than what we would have achieved by providing them to an auctioneer. So it's again picking the benchmark, understanding the value of those assets to start with, and then working out what's the best way to realise those assets through the current marketplace. It might be another one I'm dealing with at the moment. In another industry, we've actually taken a group of assets effectively to a customer, and we were able to package those up, and the customer saw, and then we've helped that customer then cash flow that over a period of 3 or 4 months. So therefore, we've given that not only the customer taken on the assets at a reasonable price, they're also then, we've given them some effectively vendor finance. Now we've underpinned that with some guarantees and other securities, but again, it's underpinned the value, and then we're then going to receive those funds over a period of 4 months. So it's really a case of looking at individual assets, looking at the marketplace, and then sitting back and going, okay, well, what's the best way to deal with those assets? The problem is at the moment, if you effectively dump it on the market, so to speak, the pricing will be a massive issue, and I don't think you'll achieve the outcome. So you've got to look at the assets, the core business, work out what is surplus, what are the surplus assets, or is the case that those assets are required now and we can realise them in 3 months' time, and just go through that process of looking at what those assets are and what value they bring to the business.
Okay. So it really is a very practical approach,
Very
and
much.
one whereby we look at each situation on its individual situation merits and the parties involved.
Every situation is different. You can't put just, obviously you have benchmarks and you have, obviously so similar methodology, but every business is different. Every business has its own little nuances. So you can't just say, this is how we're going to do it.
And that's been my experience with working with businesses in almost every sector and industry, size and shape you can think of. Every business thinks they're different, and to an extent they are different. But what we again tend to see in business is that there's some key principles around operating a really effective business that's profitable and cash flow positive, and where best practice systems and processes are put in place. So I guess that's something that we're able to offer. So I'm just thinking of time and closing it up. In fact, incidentally, one of the last questions I had really goes to.
Lost him.
I should be back.
I lost you.
I'm back now, Stephen. Can you hear me?
Yeah, I can hear you. Yep.
I'm sorry there. We just had a bit of an outage just here. Just in closing, we are prepared to offer a complimentary session to each of you. If you've got some further queries or questions, or think we might be able to help, and we will definitely send out the slides to you. And
I think we've now lost him completely. So, no, he's back.
I'm back. I'm sorry about that. It's just something that's occurring at this end. There's a hotline number there for you, 0457 958 433. We're available literally 24/7. There will be a real person here in Australia be able to take your call. And we would welcome the opportunity of being able to help you out and provide you with some fresh or some further perspective and some options. And our experience is that there is always options, probably more than you think. So for my part, I'd just like to say a big thank you to each and every one of you for taking the time to get on the webinar today. We hope we've given you something to think about and look forward to hearing from you. We will forward the slides out to each of you, and thank you very much for getting involved, and we look forward to being of help. Stephen?
Thanks, Alec. Thanks, everyone. Have a lovely day.